Hello, everybody. I hope you can hear me, and thank you all for joining us today as we've just started Lockdown 2.0. We're joined today by Shane Balkham, the Chief Investment Officer of Beaufort Investment Management, who's going to look at the financial picture, both looking back and also looking forward, and quite an apt time to do it, having Pfizer just announced that they've got a potential vaccine for Covid-19, and the market's being very thankful for that and rising quite sharply yesterday. As with all of this, if you do have any questions along the way, please write them in the chat box, and Shane will either come to those at the time or at the end. I can see we already have some questions, so we will get to those as and when we can. And thank you very much.
Brilliant. Morning, everyone. Welcome to Beaufort Investment's client webinar. And thank you, Helen and David Price. So some good questions already. I'm going to cover those off at particular points in the presentation where they're most relevant, but please keep the questions coming. That's fantastic. Should last around 45 minutes ish to possibly an hour, depending on how in depth we get. And as Ashley said, this is being recorded as well, so you don't have to take notes, and you can replay this at your leisure if you really want. So here's the agenda for today. We're going to cover the presentation of 2020 so far, and how the investment propositions have performed both over that short term and the longer term. Then we'll give our macro outlook, but that'll be preceded by sort of a navigation on how we make the decisions that we make. And then the webinar will be drawn to a close with the Q&A. But before that, we're going to have some of the lessons from history and some of the lessons to make everyone a bit of a better investor. So they're the images of what happened over the 2020 so far. They all look fairly gloomy. So what did happen? So here we have projections from the OECD, and it confirmed what we already knew. This highlights the second quarter, so the sort of the eye of the storm. And what we knew straight away was the market, the growth in the economies dropped massively. We've got the US here, and that dropped 9% quarter on quarter to the second quarter, and the revisions to the UK, we're all the way down here. We're down here, 19.8% drop in UK from the first quarter to the second quarter. A huge effect from COVID-19. It also has the dubious honour of being the largest fall on a quarter-on-quarter basis. The previous one was only minus 0.27%, and that was back in 1974. Interestingly, when we had the global financial crisis, even though we had a recession, we didn't have significant fall in the growth. It was more of a fall in the markets. It's all been the other way around this time. And although these worldwide figures officially confirmed that the majority of economies around the world were in technical recession, so consecutive back-to-back negative quarters, the numbers were probably slightly better than anticipated. So the Bank of England estimated or was forecasting a fall of minus 25%. But in the face of these recessions, central banks reiterated their commitment to combating the crisis. What we have here is the US Federal Reserve, and in their most recent meeting, they give their projections of where they expect interest rates to be at the end of particular years. So what the interest rate is going to be the end of this year, end of 21, 22, 23, and what they might be over the longer term. And you can see here, and each one of these dots represents a vote, a prediction from the member of the from the investment committee. And you can see here, we're not really going to get interest rate rises till the end of 2023. And you can see here some projections going up. And it's not into the longer run that they're trying to get back to what the new normal is going to be. And they tried to do this sort of the tail end of 2018. If you think back of 2018, last quarter of 2018, we'd come on the back of 7 consecutive positive quarters, and the markets were spooked with the Federal Reserve trying to raise interest rates too quickly. And that's when we had that drop in Q4 18 and the reversal of the Federal Reserve to not raise interest rates. Obviously, the COVID-19 crisis overtook, and we saw a massive drop in interest rates thereafter. So what we've got here is promises from the Federal Reserve and other central banks of keeping interest rates extremely low. That just helps keep the financial system rolling over nicely. As well as that, we've had a massive pledge of quantitative easing. We had this back in the global financial crisis, but here we have the Federal Reserve pledging 3 trillion in additional quantitative easing. A huge amount, huge amount. But in contrast to previous crises, and here you can see in the red line the global financial crisis, and the grey line the tech bubble, the blue line, that teal colour, that's the combating the COVID crisis. What we've had is bigger, faster, and longer. Much larger amount of quantitative easing, learning from the lessons of the global financial crisis and the tech crisis. Faster, bringing these in a lot quicker. Hence why we saw this V-shaped recovery from the 23rd of March. Okay, we're getting more W's as we go forward, and longer. The commitment to keep these in place a lot longer. And from my point of view, it's about making sure that there's a lot of powder dry. So here we have roughly 4 trillion of promises, of pledges, and they've only used 124 billion. Now think about that, 4 trillion, that's 3 times more than the US spent on the Vietnam War, and 21 times more that they put together for the Marshall Plan. And the Marshall Plan was the plan they put in place after World War II to rebuild the entire Western Europe, cities, infrastructure. So huge amount of money being utilized, but a lot of it still powder dry. So about making sure they can keep the pledges, keep reassuring the markets. It's this foundation of making sure the markets are reassured. Close to home in the UK, we had the Bank of England meeting of the Monetary Policy Committee last week, and they again committed to the same rhetoric of the Federal Reserve. It's about making sure that stimulus is increased, and we had an additional 150 billion pledged towards the UK market, so an extra 150 billion, not so many trillions on that, and that's a total of 145 billion in total pledged during this financial crisis. They also committed to keep interest rates low, so we're at a historic low of 0.1%, although they didn't stray into negative territory. They have announced negative interest rates, and that was one of the questions from David and Helen, so thank you. From my view, talking about negative interest rates is, again, it's this forward guidance. It's about reassuring the markets that they'll do whatever it takes. So it's saying nothing is off the table. If they have to go into negative interest rates, they will do to combat this crisis. So what they don't want to do is give the markets any excuse to say, okay, the central bank's only going to go to this level. They're not willing to go to here. So we've had this from the Federal Reserve, we've had this from the ECB, we've had this from the Bank of England. It's about reassuring the markets that they'll do whatever it takes. What we also had was the Chancellor coming out with the issuance of the furloughing scheme being extended to the end of March. And with the UK facing these rising COVID cases, initiating a second period of lockdown, and we still have an uncertain Brexit on the horizon, it was really essential that both monetary policy from the Bank of England and fiscal policy from the government were both strong responses and coordinated. So here we have a chart of performance around bear market since 1928, and that blue shadow in the background, that is the sort of spread of the average. So it takes away the top and the bottom and gives you what the average should be. And the grey line is the bang on average. And you can see that the teal line is how the S&P has performed during this marketplace. So here we have, that's the 19th of February, and that's the 23rd of March. You can see a huge drop down. That was only 16 trading days. But the speed of the response from both governments and the central banks allowed a very strong recovery. Yes, we're going to probably end up with, it's going to be a weird looking W. It's going to be something like that. That's why we sort of a little bit more cautious after the recovery. And it's been a very strong recovery for both stock markets and bonds, based on this foundation that central banks and governments have put in place to say, we will put fresh economic stimulus in, we will get through this. Yes, that is going to have issues further down the line. And one of the other questions from Helen David was about how are governments going to finance this additional debt, and we'll come on to that later. So it's abundantly clear, and I think that's where you've seen in marketplaces hitting certain levels and not going below it, because there is a foundation put in place. That does have sort of unintended consequences. So when we saw this sentiment change, if we go back to here, from fear, this part, to greed, going up there, the relief of fear, it does have a few unintended consequences. And this was the catalyst for certain favoured stocks to reach even new highs. Driving this significant growth in markets has been only a handful of stocks, and they all have exhibited the same sort of characteristics. They have been typically US technology companies, and also capturing the imagination of retail investors as safe havens during these sort of increasingly remote times. So, technology companies, companies with online presence, companies that help you with your remote learning. You can see here, this blue line here, that's the plus 2%. This is up to the end of September, middle of September, up 2% for the year. But underlying that is the top 5 companies, which have went up 34%. Well, we saw this drop here in September. That was typically called the tech wreck, where we saw those top 5 companies losing some value. What are those companies? They have a more familiar acronym of FANGs, stocks leading the way, emphasizing the narrowness of this market. The enormity of the performance, just this handful of stocks here, and you can see Amazon, Apple, Microsoft, Facebook, and Alphabet represented here. Alphabet being the new name for Google, and then just the standard portfolio here. We've also seen this tech wreck replayed at the end of October as well, in run up to the US presidential election. So we're a little bit concerned that this narrowness of the market, and those top 5 stocks now represent 23% of the S&P 500 as a measure of market cap, and that is the share price multiplied by the number of shares in issuance. That's how you get the size of the company. And you think about it, Apple reached in the late of the summer, Apple's value was a whopping 2 trillion. 2 trillion in size, huge, absolutely huge. It was only last year that Amazon and Apple reached to be the first $1 trillion companies, and I'm sure Amazon isn't too far behind in reaching that 2 trillion benchmark as well. If we go back to year 2000, in contrast, top 5 stocks there, different stocks represented only 18%. And it's these extremes that predicated our moves away from, in general, some large cap growth orientated funds. We're still invested in some of these, but we don't want to be wholly invested in these. It's about making sure we have diversification and identifying where the additional risks may be. And it's easy to understand why these companies have done so well. Share price being dominated by a forecast of earnings, and you can see US growth companies here beating the US main indices, the value, the Eurozone and the UK, because these companies had a little bit more clarity on their earnings going into the future. People working from home, people ordering online, people not going out to shops and hospitality, ending up with this sort of K-type recovery where you had a certain amount of stocks going up, those growthy companies, and a lot of stocks not recovering so well, being more the value-orientated companies. Now, ironically, probably over the last 2 or 3 weeks, we've probably seen a tick up of this, and particularly yesterday on the announcement of Pfizer's and BioNTech's vaccine news. So what the market needed for industrials, materials, airlines, hospitality was that the world could at some stage go back to some sort of level of normality. And the way those stock prices have been pushed down quite significantly, it's about making sure you have a diversified portfolio. And making sure you have a diversified portfolio, and this is the UK, you can see here style investing has been massively out of favor. So if the line is below this line, value is in favor, so value, and if it's above, it's growth. And you can see here, roughly since the EU referendum in the UK, growth style investing has been in favor, because you had a sort of a double headwind of not knowing what the Brexit was going to look like, and also then Covid-19 making a massive difference here as well. So it's about making sure for the future you're in an appropriately diversified portfolio. So that's what's happened in 2020. A lot has happened. COVID arguably has been a catalyst for adoption of technology, and it was that perfect storm. The right technology was there in place, ready to be adopted, and it's also allowed us to buy into certain areas because we weren't having to chase performance. I'm going to come into performance just in a minute because we are really well positioned going into this pandemic. So that brings us nicely to how did it affect your investments? So we're going to look at our multi-asset blend funds. These were launched summer 2019. And they are a blend of both active and passive and give us the best of both worlds. So this is our balanced portfolio. It has a risk profile from 4 to 6. It can go between 40 and 60%. And we'll go into how we monitor that later on. And you can see here when we launched our neutral position for equities here would have been 50%. When we launched, we felt the current bull market was looking a little bit ragged, and we felt it was prudent to launch with a position that was slightly underweight equities. So we launched with 45%. That saw us do brilliantly well in the pandemic. So we lost considerably less than the marketplace. At this point as well, great opportunities to add a little bit more risk. We went back to neutral. We didn't want to go too high. Went back to neutral, which allowed us to capture a huge amount of the returns. Hence, why we've done exceptionally well for a considerably low cost as well. So we're really pleased about the way that's happened. The same for our growth portfolios as well. And it's about then not having to chase returns. We've seen a lot of our peers in these peer groups here not do particularly well in the downturn and having to shed a lot of their more cautious holdings and buy a lot more risky holdings, which doesn't always work out. If we go to our model portfolios, this is our active model portfolios. We've been running these 16 years now. And we're never going to be immune from the downturns, but we want to make sure we lose less than the marketplace. You can see here, drop down, and each portfolio being in line. And then you can see an extremely good and consistent recovery. If we map that in against the FTSE 100 here, you can see a massive difference there. So loss a lot less than the market and recovered extremely nicely there. I think from our point of view, what's different from this and the global financial crisis was the speed of the response from the central banks and the governments, which allowed for a very quick recovery. It was almost helped investors not have to make any knee-jerk reactions. If you think the global financial crisis, this recovery was spread out pretty much over a 9 to 12 month period rather than literally a quarter. It was the same for enhanced passive. Again, not immune, but losing less than the marketplace, and another good recovery there. Again, considerably better than the FTSE 100. If we combine those two together, this is the year to date in the graph form. You can see that active has outperformed passive during the period, and active is actually in positive territory now. You would expect during these periods, or you would hope during these periods, that the active manager, this is where they should show their abilities to avoid those stocks that have dropped down, and then be able to pick up some of the stocks that are unfairly been squashed the rest of their sector. We're going to compare these now with the market benchmarks. They're called the ARC benchmarks. They take the average of the discretionary fund manager world. So year to date to the end of September, the cautious, which is our portfolio's 1 and 2 benchmarks against cautious, it was roughly minus 0.1%. Both of our portfolios are positives. We've outperformed there. Balanced is against portfolios 3 and 4. Outperformance for both active and passive. The steady growth is against portfolios 5 and 6. And the way these are benchmarked against these particular indices is where they sit in their volatility bands. And again, portfolios 7 to 10 mapped against equity risk. I mean, equity risk nearly 5%, and we've got positive performance in the active and only slightly under for the enhanced passive. So it's been a really good year so far for absolute returns as well as relative returns. So I think hopefully clients are really happy with the performance with our model portfolios, as well as our new blended funds as well. Let's take it now. Since launch, it's all very well having short-term performance, but it's about making sure you have consistent long-term performance. And this is our active funds. They are now 16 years old, so we're looking after well into the teenage years of these portfolios. And you can see here, pretty much recovered from the new highs, which is really good. And most importantly, each maintaining its position in the risk curve. So if your portfolio 7, you're getting a constant level of risk, better than 6, but not quite as good as 8. So that's really key. In order to compare, we convert the return, so it's nearly 300% for portfolio 10, and that line bar chart matches across there. And then we can compare them against the 3 indices, the 3 sort of metrics we look at, which is cash, inflation, and the FTSE 100. So we want to make sure we're doing a better job than if you kept your money in the bank. We want to make sure we're increasing your purchasing power over time. And how does that compare against, obviously, I think medias and a lot of clients' bellwethers, the FTSE 100. It's the index I think clients understand a little bit better than most. So there we have it. All the portfolios above this watermark here for cash. So you're better invested in the portfolios than you were holding your money in the bank. All the portfolios, apart from one, and it's only slightly underperformed, inflation. So don't forget, portfolio 1 is extremely low risk, performing out for inflation. And you can see here, portfolios 4 and above have outperformed the FTSE 100 over these 16 years by taking considerably less risk as well. So a really big tick for our long-term performance. We look at enhanced passive. It's a very similar story. Enhanced passive is now 7.5 years old. There's the bar charts, and there's the portfolio as well. Again, all the portfolios outperforming cash, all the portfolios apart from one outperforming inflation. And in this period here, the FTSE 100 has roughly only done about 20%. So portfolios 2 and above outperforming the FTSE 100. We also have our ethical portfolios. They've been running 5.5 years now. They've performed extremely well, seeing there's very strong recoveries here. Depending if you're in cautious, the balanced, or the growth version of ethical. And all 3 of these over the 5.5 years have beaten cash, have beaten the FTSE 100 and inflation. And interestingly here, the FTSE 100 over 5.5 years hasn't beaten inflation. And this is where it's really critical. You've got to make sure over the long term you're beating inflation. It's that hidden shadow that erodes the real value of your capital away. And finally, we have our income portfolio. We merged the 2 income portfolios. We had a high and we had a sustainable. We merged those together on the 1st of September. We were looking to do that all throughout 2019. We're doing a review of how best to form, how best to have our portfolios going forward. It's 10 years old now. And what happened was COVID and the economic fallout sort of accelerated our view of actually we only need one portfolio. We need the best of both worlds. Payout ratios have massively fallen. 54% of companies so far have either cut or stopped their dividend payments, and sources of income are at massive record lows. So we want to make sure we have one clear income portfolio for investors. And you can see there was a sizable recovery until about there, where you sort of had a plateau of performance where the sort of companies that were typical income performing companies weren't in vogue. They weren't the growth companies. Growth companies like Amazon, they don't pay out dividends. All of their profits get reinvested back into the company. So if you want to invest in that, that's not the sort of company that's going to pay a regular, consistent dividend. Actually, with the news of the vaccine on the horizon, we would expect income portfolios to do a little bit better. How have they done since launch? You can see here, considerable gap between the FTSE 100, between inflation, and between cash. So good outperformance on an overall total return. But if you're invested in these portfolios, it's about the income you're going to receive. And what we look at the high street, we look at the Nationwide Post Office and the RCI Bank as a French challenger bank as a comparative. Then we look at the low risk environment. So the lowest risk you can invest in is UK government bonds, gilts. And then we look at other assets that are going to provide you a little bit more return. If We go to the high street. Nationwide can offer you 0.05% return on your, and these are all instant access accounts. This is making sure it's money that you can get back straight away. The post office at 0.35, and the RCI Bank, Challenger Bank, 0.6. Again, the Challenger Bank, these are teaser rates. They drop down to 0 after 3 months. So massively dropped down from, one of the reasons the global financial crisis ended up being such a big drop was, banks accounts were paying 5%. Remember the Icelandic banks paying 8%. We're never going to get back to those sort of levels of interest rates for a considerably long time. If you want to have your lowest risk investment, it's borrowings to the government. If you want to lend to them for 5 years, you're actually going to get a negative return. Current negative return of -4 basis points. We get into the period of the return of your money rather than a return on your money. If you want to invest for 30 years, so you're going to lend to the government for 30 years, they will pay you 0.85% return. Based on where inflation is at that moment, you are guaranteeing yourself a reduction in the real value of your return of 50%. So if you invested £10,000, you'd get 10,000 back after 10 years, but it's only going to be able to buy you half as much as it could have done 30 years ago. If you need to have a real return, you need to invest in real assets, in stocks and shares in real companies. So then we look at the FTSE 100 there. Its current yield is 3.67%. And our own income portfolio, we want to make sure we can increase that yield, get the best of both worlds. It's currently at 5.2. That currently sits at round about sort of a 5.5, 6 risk profile. We don't asset allocate the income portfolio, but we do sort of give a measure. You can understand what sort of level of risk you're taking. So it's roughly a 6 out of 10. So the returns, the recovery from the market lows have undoubtedly been skewed, and we are definitely distinctly cognizant of the multitudes of risks that lie beneath the surface. The Covid-19 pandemic and the subsequent economic fallout continues to be felt globally, and there's definitely increasing challenges in maintaining a correctly diversified strategy. So why have I got this picture up? For those of you who don't recognise it, this is the closing scene of Jaws, and you've got Chief Brody climbing up the mast. Now, in previous scene, he was a bit reluctant to climb that mast, and this is when he utters the infamous quote, "You're going to need a bigger boat." But why is the climbing the mast now, and why am I showing you this? So this is the analogy that he's having to climb this mast because inflation is the shark. In order to get a real return, he's having to climb higher up the risk scale in order not to get eaten by inflation. So you can see here in this chart here, this is just a pictorial chart. It doesn't give any real returns. This is from Fidelity, their estimate. The more returns you take, the more risk you take, the higher returns you're going to get. And inflation here is put cash, pure bond, credit underwater. You're going to lose money. So he's having to climb up the mast here in order to get a real return, in order to stay above inflation. Map across the chart I just showed you here. So in order to stay above inflation, he's got to take more risk, because if he had a bigger boat, it wouldn't have needed to sink. So arguably, is it the boat sinking rather than inflation going up? That's the question you've got to ask yourself here. So it's about clients realizing, in order to get a real return, it's about making sure that they're taking the right level of tolerance to risk. Look at the yields here from the government. That's massively underwater. That's down here, and you're definitely going to eaten by the shark of inflation there. I hope that analogy sort of gives you an understanding that the current environment we're in, with low interest rates, that inflation will erode your level of capital. And I don't think we're going to get a huge spike in inflation. I think central banks have given us clear indications that interest rates will stay low for a considerable period of time, which means this sort of product will be below inflation, and that makes the environment ripe for inflation. But I think what central banks will do, and we've seen it with the Federal Reserve changing their methodology, how they measure inflation, to an average rather than just a standard, that they'd like to have a higher level inflation for a considerably longer period. Why? That helps erode away the value of debt. So another question from Helen David was, how is Rishi Sunak going to pay all this debt back? If we had a slightly higher inflation rate, that would erode the real value of that debt away. And with low interest rates, borrowing at 30 years at 0.85 is considerably affordable for the government. If gilts went back up to sort of 3%, then we've got a difficult situation on our hands. So I think we're going to have an environment where interest rates are going to stay much lower for longer. I mean, we've been saying that since the global financial crisis. I think we'll probably see a slightly higher inflation rate, but I don't think we're going to get runaway inflation in this environment. So that's how the portfolios performed. That's how the market has looked. So how do we make our decisions, and what is our outlook going forward? I'm going to give you some charts that we look through for our investment and asset allocation committee pack. We have a pack of about 60 pages, and actually our investment committee is tomorrow. So we have our market update. We actually look at this on a weekly basis, and this looks at both the fixed income market, equities, and inflation. It gives us a pulse, a heartbeat of how the markets are doing, and we compare that, how it's done for the month, the year, and how previous years look in comparison. That gives us some context around it. We also then look at individual asset classes and how they're performing. That helps us gain a picture of our views and our underweights and overweights, how they're performing. You can see here, let's do emerging markets. At the end of December 2019, it was the best performing asset classes for the year. It then dropped to being the worst, and it's actually gone up to being the best again. And this is to the end of June. Emerging markets being one of our overweight positions. So you get a flavour of what's doing well and what isn't doing well. We then look at the major indices for both equities and fixed income and how they're doing over the long term in comparison. You can see here you can see they were getting into the high highs back in February. We also look at the volatility, how much risk is being taken. No surprise here, you can see the big spike up for COVID-19 and how the correlation behaves. How are bonds and equities behaving differently? And you can see from a low back at the beginning of the year, correlation did spike up as both bonds and equities did well and got affected by COVID-19. And that gives us a whole picture for asset allocation. This is where we look at what asset classes, what economies and equities do think are doing well. You can see here, red, it's quite simple traffic light position for us. Red is European equities. We're underweight European equities. You can see here, we fill in that underweight. We balance that underweight with an overweight in Japan and emerging markets. And those decisions flow out through our model portfolios for active, for enhanced passive, for the blended funds. So all of our funds run off the same engine of asset allocation. And that's what's driven a lot of our good decisions. It's those decisions to be underweight going into this pandemic and then going back to neutral at the right point of the pandemic. So our good asset allocation calls have been big drivers of our returns. And that's what you should expect over the long term. Asset allocation should be the main driver of your return. So when we've made those decisions, how do we look at what's going on? How do we monitor that? And it's best looked at the dashboard we have for our multi-asset blend funds. You can see here, these are our active positions. How much do we have in active management and passive management? The neutral position is 50%, so having half in each. And you can see for the blend fund, from about beginning of March going forward, we increased the amount we wanted in our active portfolios. Predominantly, that was in fixed income. In this moment in time, it pays more dividends to have active positions in fixed income rather than passive. Passive positions in fixed income means you're buying more indebted companies. In this part in the economic cycle, we feel it makes more sense to have active positions. And you can see here at the beginning of November, we increased our active position in our growth portfolios. That was through mainly having more active positions in the UK, in Japan, and emerging markets. Then it comes to the risk side, how much we have in equity. Our neutral position for balanced would be 50%. Our neutral position in growth would be 80%. And you can see here, they launched with a below neutral position. And at the beginning of April, we increased that back to neutral for both of those portfolios, allowing us to capture a lot of that increase in return. So that's the navigation. What do we think is going to happen going forward? We wrote in the quarter review that we thought the last quarter of 2020 would be particularly eventful, which probably didn't come as a shock. But by the end of the year, we should know the outcome of the US presidential election and whether we have a no-deal Brexit. And also, we suspected by the end of the year, we might have some news regarding a vaccine. Now, 2 of those have already passed. So great timing for Beaufort Asset Management to have picked today as your webinar. So we hope as well, by the time we write the next quarterly review, we'll know what's going to happen with Brexit. We do know these negotiations have been laboriously slow and drawn out, and there are still significant differences remain. Not really much has changed since 2016. The UK's position is we want to have full control in setting our own rules and regulations, which should be seen by British courts. But we also want access to the EU single market. But the EU are saying, yes, okay, we can grant you access to the EU single market. We want guarantees that the UK aren't going to undercut. And that's where we want our cake and eat it, and the EU are going, no, we want some conditions around that. But what would be the reaction to a no deal? We would expect sterling to fall a little bit further. That would take the currency would take the brunt of the fallout. But that weaker currency could help companies cope with a more volatile market. And having a diversified portfolio would mean a weaker currency would mean any international equities we hold get a boost when they get translated back into sterling. We saw that in July 2016, a diversified portfolio massively helping us through the EU referendum wobble. But ultimately, no one knows the outcome, and it's about making sure your portfolio isn't binary, isn't predicated on an additional outcome, whether that's a presidential election, a vaccine, or Brexit. But talking about presidential election, did the markets give us a clue what the answer was going to be? Here's a survey done by ClearBridge, and it took all the elections since 1936 and said, okay, what did the market do when the incumbent won? And typically from Labour Day, it went up. And if the incumbent party lost, what happened? The market went down. So what did the S&P 500 do this time around? It pretty much followed the blue line. We had a drop here, and it sort of recovered this way. And then we had a drop here, it was a little bit earlier, and then a slight recovery. So there was a correlation here, not a huge one, but it looks like now we have a Democratic president. Now, it's not your eyesight. This is an awful chart, but it was trying to find a chart during all the muddling performance we had was difficult. And it looks like we're going to have a Democrat-controlled president. We're going to have a Senate arguably controlled by the Republicans. This blue wave that was fully expected hasn't come through. Markets have taken this news remarkably well, and perhaps having a government that's going to be run through policy rather than tweets is a better long-term prospect for markets. I think what the US has got to tackle now is definitely this rising polarization and prejudice around that. And I think that's going to help without Trump's inflammatory influence, which gives it a better chance, in my opinion. And markets have reacted extremely well. The reason we have fiscal stimulus as a blank here is there will be another fiscal stimulus package, but we think it's going to be diluted down. But that's probably not a bad thing. It's probably going to end up with a bit like a Chinese meal. You're going to have small packages of fiscal stimulus. We'll still probably get an infrastructure bill coming through, but I think both the Democrats and Republicans have got to find their feet, and hopefully Trump does find some humility and leaves gracefully. There is a new hope, though. We could be in the first innings of a new investment cycle where the market transitions from bear to hope and then comes into this nice growth phase driven by the prospects of an economic recovery, and moves from being valuation led, which it has been at the moment with the growth stocks, to earnings led. And that's going to help us. What now we've got sort of those near-term risks of politics, and the coronavirus sort of coming to the end. So I think 2021 could look really favorable. And if you think we've had the recovery already, when we bring in gains through history, here we are here to the middle of October, the gains so far pale in significance of bull markets we've had in the past, and expansions, how long that's going to last. So arguably, the current recovery looks well below where we could be, and we could be entering a new bull market phase. The news from Pfizer yesterday has definitely brought that forward. So I think 2021 and onwards could look brilliant. It's going to be volatile, don't get me wrong, but I think the headwinds that we've had in 2020 could start to dissipate. So it's about making sure we learn a lot of the lessons from history. Now, it's great. The Financial Times issued an article in their weekend feature on the 11th of July, which was fantastic. It sort of covers off all of the questions raised that we tend to raise with clients. And we get a lot of questions from clients on the lines of, if you believe markets are going to be volatile or fall, why don't you just disinvest, hold cash, and then reinvest when markets look a bit more positive? Great question. And ideally, and hopefully, the next couple of examples are going to show you that not only trying to time the market is incredibly difficult, but arguably impossible to do in any consistency. We think it's better to have a long-term investment plan that is tailored to your level of risk, making sure that you embrace the good times and the bad times. I think as a nation, we need to learn to embrace the bad times of opportunities, but we have a media that have a tendency to promote emotionally negative headlines during the dark times. And so it's very difficult to do. That's why it's important to have solid financial planners, such as those in Beaufort Asset Management, as your guides through these difficult times, making sure you don't make knee-jerk reactions, as well as making sure we are keeping to our promises of long-term investment. The first one was this desire to act is deeply embedded in our psychology. So we need to, during bad times, make a decision, but sometimes that can be our worst enemy. So here we have a study done by Clearbridge, and it looks at someone investing that's really long term. 1936, they invested $100. What would that have turned into if they just went through the marketplace, just didn't bother trying to time the markets, against someone who did try and time the markets? And their study showed that active investors who try and come out tended to come out 10 months before the peak and 10 months after the trough. So a significant period out of the market. If you were that buy and hold investor against that market timing, the market time would have turned $100 into 8,848. Don't get me wrong, it's a fantastic return. And you avoided these horrible dips here where the market is really playing with your emotions. However, if you did stay the term, you'd have returned 21,000. Significant amounts. That is a considerably long period. And it's about making sure if you do retreat from those markets, what tends to happen is timing the markets back in is intolerably difficult. You've got to make two decisions. A, you've got to get the market timing to get out right. And B, you've got to get back into the market at the right time. That's two decisions you've got to get spot on. Otherwise, you'd have been better off not doing either. And here we have the FTSE All-Share over 20 years, a bit more of a believable time period than 1936. And if you'd invested £20,000 on the 1st of February 1988 and let it run to the 1st of February 2018, what would you have returned? You would have tripled your money, £31,150. However, if you attempted to try and time the market during those ups and downs, and think about it, you're just coming off the back of Black Monday, so you're probably a little bit spooked anyway. You've got the tech crisis, you've got the global financial crisis, you've got the EU referendum in there as well. If you try to time the markets and you miss the best 10 days, you halved your potential return. If you missed additional 5 days, that goes down to 12,000. It only takes you missing the best 25 days to end up with a negative return. Negative return. That's less than 1% of your journey. And this is what your journey would have looked like. You know, you would have been tempted to time the market here, or here, or here, here, or here. Plenty of opportunity to try and time the market. So if you'd stayed invested, listen to your financial planners, listen to good investment companies, to make sure you stay the term, making sure those investment companies are open and transparent and accessible like we are today, then you can stand the test of time. It's easier said than done, I know that. And the longer you stay invested, the more you're going to see this actually coming true. And investors is making sure you follow the same behavior again and again in market sell-offs. You need this emotional circuit breaker. And what we have here is the S&P 500 back to 1928 to show you there are really bad periods. And this here is, that's Great Depression. Could have been a doctor with that handwriting. Big periods, but after that period, bear markets tended to be a lot smaller. That's the tech crisis, the global financial crisis. But on average, over that period, 69% of the time, you're in positive territory. So embrace those bad periods. Let them be let them be opportunities for you. Let them be opportunities just to rebase yourselves and make sure you have the right investment process in place. Don't be scared by them. It's long-term investing is making sure it's the yin and yang, making sure you enjoy the good times but don't get too greedy, and be respectful of the bad times but don't get too fearful. And it's about not checking your portfolio too often. You can, but that can exhibit overreaction. And this is the same FTSE All Share that we looked at the previous 10,000 turned into the 31,000, but we're looking at it on an annual basis. And here you can see 75% of the time you get a positive return. So the probability plays in your favor. Fantastic. Which is good. You look at that's great. You know, okay, 1990 was a negative year. You had 2000, 2001, 2002 were negative, but then you had 5 positive years thereafter. But it's not that simple. And this is what my daughter calls the measles chart. Market wants to give you a cold. Yeah, the market gives you these points here. These points of capitulation. These are the low points of that index in that calendar year. And if you take 1987 as a prime example, because that was Black Monday in the October, the market had dropped to minus 37%. Have you got a robust investment plan and a long-term view? If you didn't, you could have easily been persuaded to come out of the market. But if you'd have held your nerve, by the end of the year, he was in positive territory. Same for 2014, positive territory. Even the same for 2018 with that really horrible negative Q4. If you'd stayed the year, you still were better off than the low point, which was December the 27th. Stay invested. Don't be fooled by the market. How often we provided a positive return? If you stayed invested with us for just 3 months, you had a better than 2/3 chance of getting a positive return. But the longer you stay invested, higher your chance of a positive return. After 5 years, on any rolling 5-year period, you've got a 99% probability of making a positive return. There's one portfolio with only one rolling 5-year period that made a slightly negative return. Outside of that, really positive return. So that's why we say, give us 5 years. That's sort of our bellwether indicator. Same market data was done by Goldman Sachs. They looked at the whole of the market, and they found that a 5-year return for the whole of the market only gave you a 90% return. You've got to wait 15 years to get to our 90% return. But again, it's the same story. The longer you stay invested, not only does probability play in your hands, but the higher returns you can have as well, within your tolerance to risk. That is key. And if you do stay invested, you are guaranteed to receive 100% of that market correction. That market that did this, you're going to receive all of that recovery because you stayed invested. If you missed just 2 days, and if we think back to 2018, when the market got spooked by Jerome Powell coming out and saying interest rates are nowhere near normal in the US, the market dropped massively, and the market didn't recover until the 22nd of December. So just before Christmas, Jerome Powell came back and went, we're not going to raise interest rates in 2019. On Christmas Eve, 2 days later, were you still sure that was the market bottom? I don't know. If you weren't sure, you'd have lost 10%. In fact, you might not have got back into the end of January. If you missed a month, you lost nearly a quarter of that bounce. Stay invested for those longer term returns. I get told off by my marketing team if we don't show you our awards and commendations. It's lovely to have these. It's the external affirmation that we're doing a great job. We've been consistently shortlisted for Wealth Managers Southeast. We won last year. Great year, Discretionary Fund Manager of the Year, which was fantastic. If you've not seen the image there, I look very, very chuffed receiving the award on behalf of the team. This year, you are highly commended. You never get to win it twice in a year, but that's the silver medal. That's fantastic. And we're also the finalist for being Best Passive Manager, which was fantastic. PAM, Private Asset Managers Association, gave us an award for significant commendation for investment performance, which was great. And we're finalist for Boutique and Best Multi-Asset Group of the Year. So amazing. So we're really, really pleased about that. That's the really important compliance side. I know you're all going to read that when you review the review or get a copy of the slides. Thank you. Thank you for attending the investment seminar. It's been a pleasure to deliver this webinar to you. As we've previously written, we do not position the portfolios for any binary outcomes, and it's important to avoid any emotional decisions in the wake of elections, trade discussions, or vaccine rumours. It's important to have that appropriately diversified investment, one that can help mitigate negative market moves in the past, such as those associated with a no deal Brexit. Our focus has always been on diversification and how underlying asset classes have changed and adapted over time. We remain vigilant to the threats of political surprises that can produce and open to the opportunities that a vaccine could deliver. And we think it's important as ever to make sure you've got an appropriately long-term investment view, which someone like Ashley will help put together. So thanks for your attention. And if you've got any further questions, and we do have two, so thank you for typing extremely quickly. What do you see as the future of property funds? Thank you, Paul. Very good question. As you know, a lot of the property funds closed this year. Some have reopened. We've had Legal & General, we've had Threadneedle, we've had a few of the others have opened. For within the model portfolios, we think property funds are no longer fit for purpose. It is intolerably difficult to run with a fund that could close other than for liquidity purposes. So this clause for material uncertainty, now Pandora's box has been opened, we feel that the external valuers could trigger that again. So from our point of view, we think property funds are no longer fit for purpose on that. We'll still invest in property within REITs because they do give a slightly different return profile within our property and real assets exposure. So yeah, I think property assets within the models aren't fit for purpose. If you wanted to invest for it individually and over the long term, so you can be a bit more considerate of the asset class, I think that might be okay. But for us within the models, we don't think it's suitable or appropriate anymore. David and Helen, I think you definitely deserve a prize for the most questions, so thank you very much. The impact of declining dividends, higher risk volatility. Really good question. I think we've seen that already in the decline and volatility over, say, the last 6 months for dividend-paying companies. I think the announcement of the vaccine news is going to help. What you had with dividend-paying companies, it's all about look through of future earnings. And typically those companies that pay the dividends were those companies more affected by the lockdowns. Now we have a position where, and I think you've got to listen to Boris's, it's good news, but it's not the silver bullet yet, but it certainly gives us a lot forward-looking, a lot of confidence and reassurance for looking forward. And that's what the market tries to do. It's, a 6 month looking forward. I think those companies will look now and go, okay, I think the outlook for 2021 onwards looks a little bit more confident. I think the irony is, and we had meetings with fund managers last week who hinted that one of the drug companies were going to come out with an announcement within the next few days, let alone weeks and months. It could have been Astra, it could have been Pfizer, it could have been Glasgow, whereas the vaccine was on the horizon. I think the issue we have now is things like syringes, things like the glass vials. Demand for those is going to massively increase. So you're going to see restrictions on manufacture of those. We need those to ramp up. So we might have the doses, but we need the mechanisms to deliver the doses. There's still a little bit of volatility left in those. So good question. Boom, 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 boom. I like the comments. Thank you very much. It's very appreciate these. Tony, how do you see Japan as an investment location? Brilliant. Thank you, Tony. So Japan is our largest overweight position, combating our, balancing off our underweight position to European equities. We have a little bit of an overweight position to emerging markets. For us, Japan sort of hits 2 or 3 sort of green lights for us. Valuation wise, it sits really good in the valuation sector, so it's not too expensive, so that's good. It has a relatively stable political environment. So we'd have Abe stepped down because of health reasons, and Suga stepped up, who is one of his lieutenants, and he's going to continue that same process across. So we're not going to have a situation that we could arguably have in the US, where I think Biden might look to unwind, not massively, but a lot of the stuff that Trump did. So that's another tick point, and the currency as well. So the yen typically becomes a safe haven in these volatile times. So as we get a weaker dollar, we could see a strengthening in the yen, which will help our positions there. So yeah, Japan's a good one for us. That's why it's one of our overweight.
Perfect. I'd like to just quickly take the opportunity to thank Shane from us at Beaufort Financial and Reading. It's been really good to hear his point of view, both looking back and also what might be coming up. Thank you everybody for all the questions and for listening in. I can see one person typing, so I'll see if there's a question there. But if you do suddenly have questions afterwards, please get in contact with us and we can direct it to Shane. Oh, there we go. It was another thank you. So thank you very much everybody for joining.
Thank you.
If you do have any other questions, please let us know and we can speak to Shane. As we mentioned at the beginning, this is being recorded. I believe we will be sending out a copy of the slides as well as the recording. And thank you all very much.
It's a pleasure to do these, Ashley. And whenever you need the next one, just let me know.
Will do. Thank you, Shane.